The economy either looks just fine or looks to be on the brink of something seriously bad, depending on whether you look at hard data, which is measuring actual economic activity, or soft data, which is mostly sentiment surveys, things that people say they feel about the current situation or about the outlook. And you can see here the surprise index is the degree to which hard data and soft data are either coming in ahead of expectations or short of expectations. There's a huge divergence here. Soft data has been disappointing almost uniformly. Hard data has been basically hanging in there, coming in more or less at expectations. You can see examples of this if we go one more slide up. On the manufacturer side, the New York Fed's survey of manufacturers, when you ask about their outlook for orders, what their order book is going to look like in 6 months, they have never been more pessimistic than they were in the survey we just got for the month of April. The downward spikes you see in the past were September 11th, 2001, and the global financial crisis in 2008. So we are on that level of pessimism when it comes to manufacturers' outlook. Even during COVID, we didn't see this level of pessimism. There was a sense that orders were very weak currently because the economy was shut down, but that they would be better in 6 months. Consumers are saying the same thing. When you talk about consumer outlook, the Michigan survey, which has a history of being very sort of politically polarized, so we break this out here by self-identified party ID, whether you're looking at Republicans, independents, or Democrats, everybody's outlook has deteriorated in the last 2 months. Whether you are despondent or merely not as euphoric as you were a few months ago, depends on your political affiliation, but the direction is very clear in terms of how consumers are grading the outlook versus where they were at the beginning of the year. So let's go one more slide forward. Just look at the hard data, which is telling you a very different story. The Dallas Fed has a weekly series that captures things that can be observed at a high frequency. Initial jobless claims, retail sales, at same store sales, the amount of raw materials being shipped around the country. And that continues to be not just solid, but arguably even strengthening a bit. Cameron talked about this. We could be seeing economic data actually appear to strengthen in the next month or two as we get data points from times when people may have been sort of front running or trying to front load purchases ahead of tariffs. But there's no sign here that we are imminently in recession, let alone in one at the moment. One other piece of hard data that we look at, well, this is, I mean, really what contributes to the confusion about the outlook. And you're seeing here's a polymarket betting odds on whether there's going to be a recession in 2025 is really close to a coin toss here in terms of how investors think about it. Because if you look at the soft data, you're very concerned if you take that seriously. And if you look at the hard data, you're not really seeing a reason to be concerned just yet. So let's look at the two major pieces of data that we think are going to be determinative for how we end up this year, but also the direction of public policy from here. First and foremost, the labor market. We are not seeing a big increase in the number of people reporting that they've become recently unemployed and are collecting unemployment insurance. It's come up a little bit, but not anywhere near where we see in terms of distress levels of labor market deterioration. And that black line, which is showing you continuing claims, that is higher than it was a few years ago when the labor market was very strong. Probably more reflects a weaker hiring environment, not an environment where a lot of people are being laid off rapidly. As you look at other areas of the labor market, you can see that this is the broadest measure we look at. So how many people are working? How many hours are they working? What kind of wages are they earning? Year over year, this is very, very consistent, very flat, not a concern here. It looks very much like most of the 2010s when you saw this number annualizing at around 4 or 5%. As you move into the softer areas of the labor market, though, let's look at things like the quits rate. This is how many people are so self-reporting that they left their job voluntarily. That number has continued to come down as people feel less secure in the labor market, less able to find jobs other places, and that tends to be a leading indicator for wages. So we still think there's softening in the pipeline for the labor market, specifically when it comes to wage growth, which we know is the number one ingredient into consumer spending. This is not a function of the tariffs or Liberation Day. This is something that was already kind of baking itself into the cake to start the year. And then on the sort of the maximally soft side of the labor market evaluation, households' self-reported outlook for the labor market has almost never been worse than it is right now. Over 2/3 of households are saying they expect the unemployment rate to be higher a year from now, which is an extreme level of pessimism and a big jump from just what we saw the last 2 months. So again, hard data looks okay. Soft data should start to concern you. Let's look at inflation, another thing the Fed's going to be very concerned about. If we just freeze frame here in the month of March, it looked like inflation was moving down to, at long last, something that looks like the normal level based on sort of the pre-COVID environment. We saw, softer than expected inflation in the month of March. We think we're going to get softer than expected PCE inflation when we get that data at the end of the month. That's the thing the Fed really keys on. But looks like we were making progress here. But now look at this next slide. When you look at consumers' inflation expectations, they have gone through the roof. Now, 6.7% is probably quite extreme. I think people are internalizing a lot of the headlines, but it's very unusual to see inflation expectations spike like this in an environment where gasoline prices have been either flat or down across the country. Usually, those short-term kind of high-frequency purchases like gasoline and food, those need to be moving up in order for people's inflation expectations to move up. But here, it's undoubtedly about the tariff. So if you're looking at the recent data, looks okay. If you're looking at the sort of the leading indicators and what people are expecting, it looks much less good.